It would be hard for me to believe, with the damage that is being done in the service economy, which is something like 70% of the United States total output, leisure and hospitality, those kinds of things, that we don't go into a recession for at least a couple of quarters this year.
I agree, Tyler. What we're seeing today is real, tangible evidence of reduced economic activity. I can't recall a period of time in the past we've seen this. Conferences canceled, events canceled, people canceling trips, companies telling their workers to work from home. I mean, this is real, tangible evidence of reduced economic activity that will lead to a recession sometime in the near term. And that doesn't even consider what the bond market and the stock market are telling us. I think we're due for something in the near term.
Thomas, what do you think?
Yeah, I agree. I think we're probably already in a recession or about to be because of the reduced spending in hospitality and leisure. That's 15% of total GDP. So it just seems hard to avoid at least a couple quarters of a recession.
When you get that kind of fall off, and we had Tillman Fertitta on, I believe it was Monday of this week, if I'm recalling correctly. It was last Friday, and he was commenting that across his system, which is, he's probably the largest private restaurateur in the country, that he's seeing a major decline in business. David, as Jim Cramer is fond of saying, there is always a bull market somewhere. Can you find one?
Well, I'm not Jim Cramer, so I don't know that I can replicate what he has to say, Tyler. Good point. But I would say that where we want to own today in the markets, we're not going to bail out. We're suggesting our clients remain calm and stay invested and renew their asset allocations. But if you look at healthcare and real estate, those are two areas that, even though they've outperformed, there's still good value there, and they will weather the storm better than other parts of the market. So high-quality companies with low debt and good balance sheets in those industries that will outperform in an economic downturn are the areas that we think are the best place to invest today.
Thomas, I ask you this with the market just hitting fresh session lows. The Dow was down 1,450 points. The interesting thing about coronavirus is you could say the markets have been telling us since early last year that a recession was coming when we first inverted the 3-month and 10-year yields. So was this just the catalyst? Is there something, more fundamental that's broken here? Or is it just that, look, the financial markets needed some kind of correction and the underlying economy and labor market will be strong enough to carry us through this?
I think it is deeper than just a run-of-the-mill correction. I mean, the industrial economy was pretty weak. Partially due to maybe a slower China and partially due to trade problems. And then this hit kind of right as that part of the economy was recovering. But I do think they're two separate episodes, and I think this is going to turn into a real recession where that might have stayed just in the industrial economy.
What do you think the markets want to hear? If the message today is kind of a panicked, we're waving the red flag, who are they waving? Are they waving it at Washington? Are they waving it at the Fed? What does this market want, Thomas?
Well, I do think the market wants to see the Fed injecting liquidity. Today, we've seen significantly weaker liquidity in the fixed income markets, from treasuries to mortgages to municipals. And so I think it could be helpful if the Fed would continue to supply liquidity. But ultimately, I think if there's going to be something that provides a real relief valve for markets, it's going to have to be fiscal policy.